Okay, so we are going to look at our financial statements and closing entries for a corporation that is selling merchandise. This is chapter 16 in the Accounting 1 book. And really, I want to start with what the purpose is of an income statement. And so we're going to start with this blank piece of paper and kind of create us a little notes page to go along with this. I want to revisit financial statements a couple different times this year, and we went through it very quickly in Accounting 1. Really didn't get into it as deeply as we probably should, just because it's such an important set of documents for business owners to be able to make decisions, for the accountants to be able to explain to the owners, what's going on, the condition of the business, so that they can make decisions and so forth. So the main purpose of an income statement is to calculate net income. And net income basically is revenue minus expenses. And this was hopefully be net income. It could be a net loss. We hope not, but it happens. And it'll give the owners the information that they need. So this is their primary source of information for owners / managers to see the current financial condition of the business, to see the changes from previous years, and to make decisions based off this information. Okay. And it's kind of broken down into sections. We'll talk about it as we go through it. But I want to start off by talking about each of those sections. We've, of course, got revenue and expenses. But there's a little bit more detail in some of those sections. One of the things that we're going to kind of work towards in the top part of the income statement through the revenue is finding gross profit. And gross profit is basically before we take the expenses out. Okay? What are we making on our actual product before our operating expenses, before our rent, before our insurance, before our payroll, right? Before those kinds of expenses. What kind of money are we making solely based off our product? Okay? So that's what we want to look at. So one of the things that we're going to find on our income statement is gross profit. And gross profit is net sales minus cost of goods sold. And I'm going to tell you that our book actually uses cost of merchandise sold, but COGS is just a very common term, and it's a nice little abbreviation that we can use. Different sources, different teachers, different books use it different ways. Merchandise is kind of just a more formal view or formal way of saying it, cost of merchandise sold, but COMS is not quite as fun to say as COGS, I guess. I don't know. So net sales is basically your sales minus the discounts. Remember, we had sales discounts that we offered our customers, and minus any sales returns and allowances. Okay, so that's what net sales is going to be, and we'll actually calculate that on our income statement as well. Okay, and then I've explained cost of goods sold, cost of merchandise sold, and what that is. Well, let me just give you an example. If we are going to sell, okay, let's just do this little side thing. Okay, we're going to sell a teddy bear. All right, and we're going to sell a teddy bear for $15. Right? Whatever we sell, if we sell 100 of those, then our sales is going to be, what, $1,500. If we sell 10 of them, it's $150, right? That's our amount of sales, total sales. But we also know that it costs us something to make that bear. There's fur, there's buttons, there's eyeballs, there's bow ties, whatever it is, it costs us to make. So let's say that it costs us $5 to make it. Okay. We're going to make a profit on each teddy bear of $10, right? So basically, there's our sale, there's our cost to make, our cost of the goods so that we're going to sell, and there's our profit, there's our gross profit. Okay. Something else that we're going to look at is the gross profit percentage. Okay, and this will be the profit divided by the sale. Okay, so in this case, 10 divided by 15 equals basically 67%. So when investors or bankers look at your business, they want to know what your gross profit percent is. What are you making off of each product? 67%. Well, that's not too bad. Okay, you got a good markup there. All right, so here's our sales, here's our cost of goods, here's our profit. Okay, so we're gonna have this section on our income statement. All right, another section we're gonna have is figuring out what the cost of goods is. Okay, and to do that, we use some of the accounts that we already have set up. Okay, so to figure out cost of goods sold, what we're going to do is we're going to take beginning inventory. Let's see. Okay, beginning inventory plus purchases. Okay, so beginning inventory is that physical count from January 1. It was a physical count. Okay, and it should be January 1, or the beginning of your fiscal year. Okay, so we've got to find that number for January 1. It actually should be in your ledgers, in your trial balance. We just have to know where to find it. Okay, so that's all the inventory we had on January 1 sitting in our warehouse or sitting on our shelves. Then throughout the year, we've made a bunch of purchases, right? Every time we purchased our merchandise, we put it in the purchases ledger, journal/ledger, right? Now this is actually net purchases. I should have put net purchases, because we do again have discounts and returns and allowances. Okay. And this is, of course, how much we bought throughout the year. All right. Those two things added together are what we can call, or what I like to call, GAS, which is goods available for sale. Again, your book will probably say merchandise. Merchandise available for sale. Okay? I just like to use these little abbreviations. Okay? Then we're going to take out ending inventory. And this is that physical count on December 31. Okay? And so when we figured this out before, when we looked at our worksheet, right, our ledgers have the information for January 1. Okay, because that's where it was sitting at the end of the previous year. Okay? We looked through our ledgers to find what our total purchases were. And then by doing our physical count for December 31st, we know what our ending inventory is. And we've done an adjustment in our worksheet from beginning to ending inventory. Okay? But this ending inventory is basically now what you have left. So if this is what you started with, this is what you purchased, this is what you have at the end, the difference between all of that is what you sold, right? Therefore, it's the cost of the merchandise that you sold. Your cost of goods sold. And this is the dollar amount of your items or your merchandise sold. So now, if you know your sales, okay, and you know the cost of the goods that you sold, you can figure out what your profit is. Okay? Then we take our gross profit. Sorry, I'm going to run out of room here. Minus your operating expenses. Okay, and these are those expenses like supplies expense, insurance expense, utilities expense, rent expense, payroll expense, right? All of those things that we've talked about as expenses are those day-to-day operations of a business. Okay? All right, and then this will equal income from operations. Okay, so your basically your revenue, your profit from making and selling your product, minus all of those day-to-day expenses, gives you your income from operations. But there could be some other things. Okay, we will see other income listed, and then of course we have our taxes. And we always want to list that separately because that's just, people, we can't control that too much. And this is after taxes, right? And that's what we're looking for. All right. So there's you kind of a notes page. I would definitely want you to keep this page. This is something we want to look at again. It's something that we may want to look at when we do some UIL practice. That could be for some of you, that could be for all of you. Not sure how that's going to work at this point. But this is a good sheet to have, I think. So keep that with you. Okay? All right. So now actually looking at chapter 16 a little bit more. Couple of things. I know that when we did the income statement for Authentic Threads, it was definitely much more intense than what we had seen before. So, just to make that point again, right here, this was the first income statement we did back in the middle of accounting 1, right? That's all it was, revenue and expenses, right? But if you did the income statement for Authentic Threads, it was an entire page long. And you did the cost of goods sold. You did a long list of expenses. You did the gross profit. We just didn't have time to really talk about it and dig into it and truly understand it. Okay? The other thing that we're going to see a little bit different, excuse me, is the worksheet. Oops. All right, so this is the worksheet that we looked at and worked on. Again, back in the middle of accounting 1, where we have our trial balance, we have our adjustments, we have our income statement columns, and our balance sheet columns. And of course, the one we did for Authentic Threads was similar to this layout. It was 8 columns, but it was, of course, a lot longer. But you can also do a 10-column worksheet. And that's kind of what I want you to understand as we're going into this, because they're going to show you some partial worksheet columns, basically, and that's where you're going to pull your numbers from. But I just want you to understand what they're having you look at, okay? Because what they're having you look at is what they call an adjusted trial balance. So here's our trial balance. These are all the numbers that came from the ledgers, okay? Then we have our adjustments, and then we extended those numbers straight into income statement and balance sheet columns. But sometimes there's an extra 2 columns in here for an adjusted trial balance, okay? Or sometimes they just go to the adjusted trial balance and they don't really have the income statement and balance sheet columns directly here. So I just want to show you that difference real quick. Here's an example that I found. So I know the numbers are pretty small. I don't know if you can clearly see them. I don't think I can zoom in when I'm recording. Okay. All right, so here you can just see all of the accounts. You can see the trial balance. Again, this is what came directly from the ledger. Then you can see our adjustments labeled with their ABCs. Then we take these and we extend it to an adjusted trial balance rather than taking it straight to the balance sheet. Okay, so what we're going to be working with more often than not in accounting 2 is just an adjusted trial balance set of numbers. Okay, so what you have to understand is that there was a trial balance, the adjustments happened, and here's the new numbers. It's not taking it all the way to balance sheet and income statement with just these 2 columns, but we could definitely figure that out, right? We're taking it straight to the income statement and balance sheet, not to these columns and then to an income statement and balance sheet. Okay. The other thing that I want to remind you is when we get to merchandise inventory, right? This trial balance number is the January 1, right? And then after the adjustments is the December 31. Okay? This was that physical count for the previous year from the trial balance columns. And then when we did a physical count at the end of this year, December 31, this was the new number.